Hi, this is Professor Cataldo, and I'm going to go over the very basics of a worksheet for pensions. This material that I'm covering in this PowerPoint group is more advanced than what you would need for introductory financial accounting. This is the basic foundation for what you would get or cover in an intermediate financial accounting course. There's the worksheet, and there's some actual numbers. I took these out of a textbook. And you want to look at the headings first. The far left-hand side, annual pension expense. That's going to be the expense that you book on your income statement. Next to it is cash. That's the amount that the firm is going to write as a check based on actuarial assumptions for the pension. I am not going to cover other comprehensive income items in this particular PowerPoint slide. But the PSC is prior service cost, and the gain loss is a gain loss, of course. The next column, pension asset or liability, that is the net measure. And over on the far right-hand side, you see pension benefit obligation. Obligation, think in terms of liability. Plan assets, think in terms of the portfolio. Now, the pension is going to be administered by a pension plan administrator. The firm's not going to do it themselves. So as of January 1, 2014 in this example, you have plan assets at 100,000, pension benefit obligation or liability, if you will, at 100,000, and the net pension asset or liability would be zero. I did not put the zero in that column. And I'm going to walk through each of these items in a few minutes. First, I want you to notice this is a worksheet. It's a worksheet format, and this is what you want to be able to visualize to understand pension accounting. The far right-hand side, those are memorandum entries on a worksheet. They are not part of the journal entry. That's important. They are not part of the journal entry. Start with service cost. Notice the service cost for the people currently in my pension plan, and we're going to use data on them. The actuary is anyway. They're going to have the ages and the years of service, and this is what we assume the cost is for this particular year for the service for the beneficiaries in the pension plan. So I'm going to debit annual pension expense and credit pension benefit obligation. My liability has just increased on the right-hand side. Interest cost. This is part of the rate of return. This is the interest. So that increases the annual pension expense. That's a debit. And it also increases the obligation or the liability on the right-hand side. That's the credit. The actual return on the portfolio for the year. So this pension plan has stocks and bonds. The actual return is 10,000. That's the assumption. So that's going to reduce my annual pension expense. If I have a lot of equities and the stock market does very well for a particular year, that's going to reduce the firm's annual pension expense. So credit, a reduction in the expense that's going to be booked on the income statement for the firm. On the right-hand side, there's an increase in the value of the portfolio or the plan assets. Contribution. The firm just wrote a check for $8,000. So that's a credit to cash. And on the right-hand side, we can see that once that check was deposited into the portfolio, into the pension plan, it increased its value, the asset value. Here are benefits that were paid out for the period, for the year in this case. And those benefits, based on actuarial assumptions, reduce the obligation by $7,000. That's a debit to a liability, think in those terms. And it's a credit, of course, to the assets. Finally, we have the journal entry. Notice the journal entry is not using the two far right-hand columns, which are memorandum entries. They don't actually get booked. So I have a debit to annual pension expense, a credit to cash, and I have an increase in the liability on the firm's balance sheet. If you want to, you can look at the far right-hand two columns. Notice that the obligation is now $112,000 and the plan assets are $111,000. That's why we had to make that credit entry to the net asset or liability carrying value on the pension. These are the basics, very basics, or the foundation for pension accounting. It does get more complex. Make sure you understand these basics very, very well before you proceed to related more advanced topics. Thank you.